What if you could break free of the endless paycheck to paycheck cycle, escape all of your financial stress, and build a future where your money works for you instead of working the other way around? Now, sustainable wealth isn't just for the elite, it is for you and I as well. It's achievable for anyone with the right strategy and the mindset. So, in today's video, we're going to be looking at the guide to sustainable wealth building, where we unlock secrets to creating everlasting financial security. Building wealth is more than accumulating money. It is about stability. It is about freedom. It is about the opportunities for yourself and the future generations that you have. So let's start this off with our first one, adopting a long-term mindset. Now, when we think about this, avoid emotional decisions. When it comes to investing, when it comes to budgeting, when it comes to impulse buying, it is about the emotions that you feel. Even in volatile markets like what we're seeing, stick to the plan. When you have a long-term mindset, you're thinking in the next 3 to 5 years. You could be thinking the next 5 to 7, 10, 20, 30 years. Emotional investing will often lead to loss. When we start seeing the market go down, when we start seeing social media, when we start seeing the news, really picking up on a lot of different things, people will cash out of the market, and they will usually cash out of the market as soon as it starts going red, which is the wrong thing to do. When you look at history, when you look at rebounds, usually we might have a couple days of down, then 1 or 2 days where we'll actually see a little bit of a rebound. But when you start looking at that long-term mindset and thinking again that 5+ years, the market always does kind of come up green in an extended amount of time. Now, second one we look at is focusing on your compounding growth. So if you're selling out of the market, you are taking those losses. You're cashing out, you no longer want to play the game. Reinvesting your earnings is harnessing the power of compounding interest over time, especially if you are in those low-cost ETFs. If they do pay dividends, it can compound over time, and the growth is going to be there. When we start again looking at a long-term mindset with the S&P 500, it is really where wealth is grown. When we start thinking of millionaires, over 90% of millionaires are grown from the S&P 500. It is traditional investing. It's not the Bitcoin. It's not the get rich quick. It's not the real estate. It is a majority of people are making money by regular deposits in the 401k, dollar cost averaging every 2 weeks when they get paid, and leaving it there, the compounding growth for an extended amount of time. And of course, when we start thinking long-term, set milestones. This is a huge thing. When you think of long-term milestones, what do you want to achieve? It could be small, 6 months, 12 months. Make sure they're achievable. Make sure you're maintaining those milestones, because that is going to be the absolute game changer. If you want to save $10,000 in a year, celebrate when you hit that milestone. If you fall a little bit short, is it realistic? If you're making and want to save, let's say, $50,000 a year, and you're making $50,000 a year, probably not going to be a realistic goal for you to achieve. So make sure they're realistic and make sure that you break it into smaller chunks. So if you're looking, let's say in the next 2 to 3 years, you want to save up and you want to buy a house. Okay, how much money do you need? Let's say in the next 3 years, you need $30,000. Break it down into months, break it down into paychecks, break down exactly how much you need to save to go ahead and hit that goal. Now, second one we look at is diversifying your investments. This is something you have to focus on. If you put all of your eggs in one basket, chances are it could be a really cool story if it was something like Nvidia 10 years ago, but for a majority of people, the diversification, they will lose money. When we start looking at domestic stocks, when we start looking at international markets, a lot of people like to have the exposure kind of on a global level. Me personally, I choose to invest in just the US markets. I know a lot more about the companies. I know kind of the ins and outs, and I don't know exactly when I start looking at geographical diversification going outside of the US markets. A lot of the companies in the US, which majority of them are global companies, they are operating everywhere around the world, including China, which still has some pretty good tariffs in there, but they are working in a global market. Now, when we also think about the diversification, alternate assets, this is something that a lot of people don't look in. They put their money in their 401k, and that is exactly where it stops. When we start looking at commodities, when you look at private equities, when you look at real estate, when you look at artwork, there are a lot of things that can really broaden your portfolio, even cryptocurrency, keeping it in a small amount in an alternate asset, let's say even 3 to 5%. Some people like to do gold and silver. There's a couple different things you can do to really diversify the portfolio to keep some of those funds out of the stock market itself. And the next one they talk about is rebalancing. Now for this, I really don't agree with the rebalancing, because what you're doing during rebalancing, if you're doing this on a regular basis, and I know the CEO, I believe it was Goldman Sachs, that said rebalancing doesn't really make sense, because what you're doing is you're taking an asset that is a high performing asset, that is a growing asset, and you're selling it off to replace a lower asset that is underperforming. So essentially, you're taking money out of something that is higher performing, putting it into something and really trying to bring it up that is lower performing when the performance could stay lower for an extended amount of time. The way that I do it through dollar cost averaging is if you have something that is absolutely running, that is crushing it, keep letting it crush, keep letting it build. Don't sell it off, don't remove it, don't rebalance it. Doesn't really seem to make sense to me. Now, when we look at number 3, mastering your budget and your savings. Guys, if you're living below your means, if you're living, let's say 85% of your income, that is giving you 15% to save. When you start looking at an extended amount of time, if you are saving 15%, that is a big chunk of income. Let's say through your 20s, 30s, 40s, 50s, you're going to be a multimillionaire with saving 15% of your income. When you put in the compounding factor, as long as it invested properly, it will work incredibly well. Now, for this, we also talk about automating. Automation is everything from savings to investing to 401ks. We're looking at HSAs, we're looking at IRAs, even looking at bill pay. This really ensures the consistency of automating all of those accounts, making sure your bills are paid, making sure those investment accounts are funded. It can simplify your whole entire life. Now, when we start thinking about budgeting and saving, debt and debt repayment and debt management is the number one killer that I see. With financial counseling and education, high interest debt will improve your cash flow if you're paying it down, improve your financial health, and even your mental health. There are so many people that burnt out because they're spending so much money and putting it towards those credit card bills, and the credit card payments, unfortunately, are not moving. When you think of high interest debt, it is going to absolutely be detrimental to your budget. You want to get rid of that as soon as possible. And when it comes to budgeting, tracking, and adjusting, continuing monitoring exactly your spending habits, refining your budget, seeing where you can make a couple more dollars that are going towards that debt repayment or a little more that is going towards that investment account can make a very big difference in the long term. Number 4, we get into embracing continuous learning. This is something when you look at financial blogs, when you look at YouTubers, when you look at books, when you think of everything, deepening your understanding of the financial markets and understanding exactly how things work is an incredible gateway to financial freedom. When you start looking at credit card, how do they calculate your interest? What is your interest rate at? Start at the basics. When you look at a mortgage, when you look at an auto loan, your savings account, your credit card, what exactly are your interest rates? Do you know what you owe? Do you know what you're spending? Do you know where your subscriptions are? Make sure you take accountability and knowing exactly your stuff. Now, learning from your mistakes, look at past decisions. Did you make poor financial decisions? For a lot of people, if they did, that's when they say the market is bad, the market is evil. They pull all their money out of it and they're not going to invest it anymore. That is a mistake. Learn from your mistakes, invest money over time. Even if you're newer to investor, start with $100. Put it into an investment account, play around with it, see where it is, see what it grows to, feel and get a really understanding of how the application works, how the trading works, what the trade windows look like, and know the in and outs of a platform before you start investing real money. And of course, joining communities, looking at forums, asking questions on YouTube, exchanging ideas. I have financial advisors, and I have a lot of financial advisors that I've worked with through the years that I still really keep in contact with, staying updated on financial trends, what's happening in the market, what do we see going on, and making sure, again, that education piece. And the final one that I'm leaving you with is the biggest one from Warren Buffett itself, investing in yourself. When you think of the ability to go to school, to get certifications, to have courses, making sure you're competitive in your field. And we're not talking about trying to earn more salary. We're talking about bringing more value to the workplace. If you're an individual that works and unfortunately they cannot replace you because you become so valuable in the workplace, when you ask for a raise, it's going to be sure. If you do look for another company, bringing a ton of value, education, and really knowing what you're doing is going to be a game changer when you start really setting your own salary. This can include building a network of individuals, cultivating relationships, mentors, peers, industrial leaders, professionals. These people open doors. There's a reason why the rich hang out with the rich, and the people you surround yourself with is the exact people that you're going to be known for. They always say your 6 closest friends really dictate who exactly you are, and prioritizing your health. When we think of a healthy lifestyle, physical, mental, really working out, equipment to sustain wealth building activities, making sure that physically you're okay and you don't have anything going on emotionally or mentally. All right, guys, so that is going to do it for the guide to sustaining and really building wealth. Let me know in the comments what you guys think. And as always, thank you guys for watching.